On January 10, 1980, Dr. Albert Johnson, a dentist in Oklahoma City, withdrew $10,000 from his savings account and marched determinedly down to a local coin shop. Despite the scenes he had watched on television, he was surprised to see a line snaking around the corner. But he waited patiently for 40 minutes to buy some gold coins. Little did he know that he would have to wait a lot longer to turn a profit, 28 years to be precise. At the beginning of 2008, he finally had a profit. Long cycles for commodities. To everything there is a season, as the good book tells us. For commodities, the cycles tend to be longer and more extreme than for many other products or services. There are sound economic reasons for this, far beyond the excessive speculative nature of resource investors or the natural tendency of investors, humans, really, in all their pursuits, to assume trends will continue. First, we should recognize that the very long-term trend for most resource prices is downward. This is not true, however, for gold and silver, which have monetary attributes and tend to hold their value. But for commodities, generally, prices today, for example, are still below, in real terms, prices in the mid-19th century. Why is that? As economies develop, they move away from basic industry toward more high technology and services. Moreover, there is much more efficiency in the use of resources. Despite the United States' reputation as a gas guzzler nation, the input of energy into each unit of production is far less today than it was 20 and 30 years ago. Technology plays a role, creating more efficient substitutes with less resource usage. Fiber optics replacing copper wire is a clear example. Technology also plays a role in improving exploration and production of resources. Think of the massive pre-salt oil fields off Brazil's coast. 20 years ago, they would not have been discovered, nor would anyone be thinking seriously of producing from them in any realistic time frame. The ultra-deep-sea technology did not exist. None of this invalidates the theme and conclusions of this audiobook, namely, that we are only in the middle of a long-term supercycle for commodities, one that will see significantly higher prices. Within this very long-term downtrend in prices are periods, sometimes quite long, of dramatically increasing prices. I am not referring to price spikes caused by supply disruptions resulting from wars or natural disasters, but rather to the multi-year periods of upward price movement caused usually by a new source of demand, be it in the early 19th century from Britain, in the late 19th century from Germany, in the 1910s from the United States, and after World War II from the rebuilding of Europe followed by Japan, Korea, and Taiwan. Once the economies of these newly developing countries mature, demand reaches a new plateau, and the inexorable decline in prices resumes. See Figure 1.1. Higher prices can also come about because of easy credit, sparking a false economic boom. I will have much more to say about this later. Similarly, low prices tend to come about from broad declines in economic activity. However, from time to time, lower prices can result from specific developments, such as a major new discovery, for example, the California gold rush, or new technologies that enable erstwhile uneconomic ores to be mined profitably. Such price adjustments tend to be temporary, however.